How do you calculate current ratio? Current ratio is, we all have seen current assets, and I'm sure all of us would remember what current assets are. And we also understand what is the current liabilities, and I'm sure all of us will understand as to what is the current liability. How do you calculate this ratio? So let's say there's a company whose current assets are 400 and current liabilities are 200. That means what is the ratio? The ratio is 2. Ratio is 2, right? So that's your current ratio. Now, on this current ratio depends as to how good is the working capital management of the company. Working capital management of the company. Please remember, working capital management is directly linked with the current ratio. If I ask all of you as to what should be the current ratio of a company, I am sure it is quite possible most of you would say that the current ratio of the company should be as high as possible, or it should be high. Let me tell you, that is completely wrong. That is completely wrong. If you are a company making profit, paying to all your lenders, suppliers, employees, government, and everybody in time, then as a choice, as a design, you must work to reduce your current ratio as much as you can. And please understand, why should you work to reduce your current ratio as much as you can? That is because if your current ratio is high, it means what? It means you are carrying too much of inventory. If your current ratio is high, it means what? It means you are carrying too much of receivables. If your current ratio is high, it means what? It means you got too much of money lying in the cash and the bank with you. And if your current ratio is too much high, it means what? It means you are not getting proper credit from your suppliers. And remember, if all this is happening, this is a bad sign of working capital management. And why it is a bad sign of working capital management? That is because as a business, I am locking my capital in inventories, in receivable, in cash and bank balance, and not using suppliers as the source of funding my working capital. And therefore, please remember, these are the four factors. So reserves and surplus, debt equity ratio, current ratio, and working capital management. So the moment you start reducing your current ratio, and I'm sure all of you can very easily understand it, automatically there is an efficient management of working capital in your company. If your current ratio is going down by choice, by design, it means what? It means your inventory is going down. It means your receivables are going down. That means your money is coming faster from your customers. If your cash and bank balance is going down, it means what? It means you're not keeping idle cash with you. You're using it, deploying it profitably in some investment or the other. And that is what working capital management is all about. So this is how you can figure out as to whether it's a good balance sheet or it is a bad balance sheet. I can take one question on this, please. Okay, right. So